If you're like most traders, there are certain times where you look at the market and you can't really decide whether you think it feels bullish or bearish. There are times where you just get the sense that the market may just chop around with no particular direction in the near future. This will often happen during vacation periods in the summer and sometimes near holidays. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and we have lots of trading strategies for pulling some money out of the market during periods of time where the market isn't really heading strongly in one direction or the other. In this video, we're going to teach you how to trade a weekly option strategy where you can potentially pull $1,000 or more out of the market in a week if you understand how it works. So if that sounds something that you'd like to have in your trading arsenal, then stick around and learn the details of this strategy. Hi, I'm Seth Freiberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. You might have noticed that there are certain times of year where the market begins to slow down a little bit, which happens often in the summer when people are going on vacation or close to holidays, when trading volume comes down as people start winding down their active trading. And so at those times, it may be a little difficult to discern a clear cut direction for a stock or the market as a whole, because what you're seeing might just be market chop, fewer market participants and less volume. Is changing hands and no particular strong momentum is going in either direction. And so it's particularly in those times that a little knowledge of option strategies that actually prosper when the market isn't moving very much can come in handy. And those strategies are known as market neutral options income strategies. And what we'll be teaching you in this video is an example that uses stock options. Now, I realize that most of you probably know something about how stock options work, but just for a quick review, and this will be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock is going way above the strike price of the call buyer can exercise his right to buy 100 shares at the strike price of the call option that he owns. In other words, he's entitled to buy the shares way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put option he owns, the buyer of that put has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock has gone way below the strike price of the put. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closed above the strike price of the put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so with that in mind, let's head back to December 10th, where we see the SPY was trading around its all-time highs up at 468.5. And let's say on that day, you went ahead and on an options chain expiring exactly a week later on December 17th, you sold 8 calls at the 474 strike price, about 5.5 points above the stock's price that day, while also selling 8 puts 5.5 points below the market price down at 463. And at the same exact time, you'd buy 8 of the 484 calls for protection and also buy 8 of the 453 puts for the same reason. Both of those 10 points farther away from the market, as you can see. And so this entire structure that we just described is what options traders refer to as an iron condor using SPY options. Now, before we get into how the iron condor trade works, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. And in that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock you like where you'll make your target profit, whether the stock goes up nowhere or even down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up the free registration page in a new window. So don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so we've constructed this iron condor and we need to look into the cash flow of the trade before we explore the rationale behind it. So from a cash flow standpoint, as you can see, when we sold those 8 calls, we received $1.16 for those. But remember, each call option represents 100 shares of SPY stock. So we multiply that by 100 and we sold 8 of them. And so as you can see from the calculation, we received a total of $928 for selling the 8 calls. And using that same logic, having received $2.75 for selling the 8 puts, we receive a total of $2,200 in cash for those. And we also bought 10 calls for upside protection further up the options chain at 484, which cost $80, while simultaneously buying downside protection 10 points further down the options chain from the puts we sold at 453. And that cost us $896. So when you net it all down, the trade resulted in a net cash inflow of $2,152. And your broker will require you to have at least $28.48 in your account to enter this trade, which is also its worst case scenario. Okay, so that's how the trade starts from a cash flow standpoint. But the larger question is, why did we do this? And the answer is this. Let's suppose that when these options expire in a week on December 17th, think about hypothetically what would happen if the SPY closed at any price between 463 and 474. Well, think about it. As we mentioned earlier, at any price above 463, both of the puts have no value because no one's going to exercise their right to sell SPY shares at 463 on December 17th if SPY is trading above 464 in the open market. And the same thing for the calls. No one is going to exercise a right to buy SPY shares at 473 if the stock is trading at less than that in the open market. Obviously, that would be crazy. So all 4 of those options have no value. And thus, you as the seller of the iron condor just walk away with that initial $2,152 that you originally got when you entered the iron condor trade. In other words, and this point's critical, you want the SPY to close between those 2 prices, 463 and 474. You actually want all of those options to expire worthless because then you get to walk away with that $2,152 if that happens. Whereas if the market closed above 474 or below 463, then you'd either be obligated to buy shares at more than they're worth in the open market in the case of the puts, or sell shares at a price below what they're worth in the case of the calls. And in either case, the loss you take for doing either of those things could exceed the $21.52 you got in at the beginning of the trade, in which case the trade would be at a loss. So with iron condor trades, you try to avoid being in that situation. And so you set the trade up initially so the market has to make a pretty good move for you to be in that position. But now think about it. What if, in fact, the market does make such a decent move? Does that mean you have to lose money on the trade? And the answer is definitely not. In fact, in this case, it turns out that 4 days later, the SPY actually did sell off below the 8 puts we sold at 463. And so A very common tactic at this point is to go in and close the put side. So we buy back the 463 puts and sell the 453 puts that we owned and come right back in and sell the 458 puts and buy the 448 puts. So if you look carefully at what we did there, we essentially closed the original put side of the Iron Condor and reopened the whole thing 5 points lower. And that move is what is called a put condor roll in options language. Now, why we did that will become more clear as we proceed to walk through the trade. Now, let's first take a look at the cash flow implications of executing this put condor roll, because that's going to be important for you to understand the trade. So first off, to buy back those 8 463 puts, as you can see from the calculation, that cost $3,800. But remember, we also own those 453 puts as protection. So we sell those off and cash those in for $1,264. But we're not done, because we're rolling this position down. So we also now sell the 458 puts lower than the original puts we sold, and we get in 2320 for those 8. And we also reestablish our protection at 10 points lower than that at that 443 price, 443 price, and we pay 712 for those. So netting it all down, the total cost of the condor roll is $918. Now that's important because remember, we originally received $2,152 for those options, but we just spent some of it to the tune of $918. And so we're now down to a positive cash flow of $1,234. And the new position looks like this, with the put side now relocated. So the 8 short puts are at 458 and the 8 long ones are at 448. Let's move to the day that these options expire, which is December 17th, a few days after the condor roll. And as you can see, the SPY closed at 461 that day. And so at this point, the options comprising the new Iron Condor position have expired and they will be settled by the options market. So let's take a look at exactly what happens that day. And it's pretty straightforward because all 4 of the options expire worthless. Why? Well, the 2 call options are above the market at 47, 474 and 484. And so as we explained before, they've got no value and no one's going to exercise their right to buy SPY at prices above the market's closing price. And likewise, the 458 and 448 puts expire worthless because no one's going to sell their shares at 458 when they'll get a higher price of 461 in the open market if they sold them. And so all 4 expire worthless, resulting in the Iron Condor trader just walking away with that net cash of $1,234, which remember is what was left over after he did the condor roll to protect the position. And so what I'd like you to take away from today's video is the fact that there are option strategies such as the Iron Condor that make money if the stock stays in a tight range around the price it was in when you entered the trade originally. But if the stock price moves, there are easy fixes like the put condor roll that can be used to basically widen the range into which the stock can close on expiration day, and the options will still expire worthless, which is the goal actually, because that allows you to retain the remaining cash after you paid for the put condor roll, which in this case left you plenty of profit and certainly a nice return after just a week. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. Please remember to click on the subscribe button right now so you won't miss all these free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.